It's expected to be the busiest week of the year for IPOs, the busiest week for big IPOs in 4 years. 6 firms are set to begin trading, and if they all price at the top of their ranges, the more than $3 billion raised would be the highest of the year. So what is this telling us about the capital markets and investor appetite for risk? Joining us now is Ralph Schlosstein, Evercore founder and senior chairman. And Ralph, it's great to have you back on the show.
Great to be back.
So the fact that it's September, seasonally, typically, this is a weak month of the year for stocks, and yet IPO market is rocking and rolling here. Signals what?
Signals that the market is very well bid, that there's funds flowing into the equity market, and that investors are looking for new stories in which to invest, particularly, now that valuations are, pretty high. And so for the first time, for example, you're starting to see private equity firms and venture firms looking at the public markets as a legitimate vehicle for capitalizing the value that's been created.
How does it speak more broadly to the deal-making activity and environment right now? It was just a couple months ago where we were talking about uncertainty, and it seems like corporate America is moving past that, or at least investors are.
Yeah, I think corporate America particularly is. Obviously at Evercore, we spend a lot of time in corporate boardrooms. And first of all, if you look at the M&A statistics this year, the dollar volume of activity is up about 30% globally. But the number of transactions is actually down 15%, mostly transactions under $100 million. So substantial large deals are back, big strategic deals are back. And certainly the conversations we're having in corporate boardrooms and our backlogs reflect that. I think the same is true for institutional investors. I think the last time I was on your show, we talked a little bit about the Fed and whether the Fed would cut in September. And I said that to me, the expected case is 2 cuts. And if you ask me which is more probable, 3 or 1, I would have picked 3. That seems to be becoming more of an emerging consensus. And I think we're at a world right now where you've got supportive monetary policy coming down the road. You have pretty stimulative fiscal policy with the bill that was just passed. And so it's hard to see that the economy isn't going to do reasonably well. And therefore, the stock market, which is normally a leading indicator, is probably indicative of that.
So, Ralph, M&A had been hung up for a while, it seems, with private companies holding out for higher valuations, big companies, potential acquirers waiting for the smaller ones to adjust to reality. How would you put into context what happened and whether the M&A that we're seeing now, how it affects whether that's going to continue?
Well, you have, in the private equity world, you have 12,000 companies that are in private equity portfolios that are looking to be have their value realized. A modest number of those that will happen through the public markets, through IPOs. But private equity firms have come to the realization that the surest and fastest way to capitalize on the value that they've created is to sell, either to a strategic or, in many cases, to another private equity firm or through a continuation vehicle. So there's a huge backlog of companies to be sold. And if you're in one of the, reasonably sized or larger private equity firms, returning capital is fundamental to your ability to continue to be in businesses. So I would say the motivation there is extraordinarily high. And given the amount of capital on the sidelines and the valuations in the public markets today, I think there's going to be a pretty significant deconstipation of private equity.
Okay.